Marc Faber has joined us round the desk. Welcome, Marc. Good to see you. Thanks very much for coming along. Marc Faber, editor, of course, of the Gloom, Boom and Doom report. Should get it right. Marc, we appear to have enjoyed the flush of a cyclical recovery based on the easy money made available by central banks. Is it going to last into the second half of this year?
Well, I think there'll be a slowdown, and a meaningful slowdown. I think the Chinese economy will slow down. Some people think it will crash. I think they can probably avoid a crash, but the slowdown is coming. But it doesn't mean that the markets will go lower. As soon as the economy slows down again, because the stimulus is probably going to wane also in the United States over the next couple of months, what you will then see is more stimulus and more monetary easing. In other words, I think interest rates forever in the US will be at zero. By zero, I mean below the rate of inflation. That was also the pattern after the recovery, which began in November 2001 up to 2007. The interest rates, the Fed fund rate, went from 1% in June 2004 to 5.25% in August 2006, but there was never any monetary tightening. So with Bernanke at the Fed, I don't believe that we will have ever real short-term interest rates that are above 1. I think they'll stay below zero.
That's a huge statement to make. But
yes, but that's exactly the history of the Federal Reserve.
But that suggests that the multiplier is broken forever, doesn't it, from here? That any attempt to push on that string is not going to result in inflation.
Well, it will result in a lot of inflation, but inflation has many different symptoms. One symptom is obviously a weakening of the currency, and we had that weakening of the US dollar 2002 to 2008, and then in 2008 the dollar strengthened again. And as soon as they eased again massively, we had dollar weakness in 2009. The problem is that the other currencies aren't much better than the US dollar. So I think that maybe against the euro, the dollar will rather appreciate more.
Let us just remind you, Bob Parker is here. Bob's a senior advisor at Credit Suisse Asset Management. And Marc Faber is our guest host this morning. He's editor and publisher of the Gloom, Boom and Doom report. Gentlemen, let's pick up some viewer email and let's just address some of the questions that our audience are very interested in hearing about. And I think it's still very much square and centre whether the authorities that are now in charge of fiscal policy are going to manage us out of this easy money condition appropriately. Ken writes in and he says, well, I think this gives you a taste. The Fed, Bernanke, Geithner, Lehman, Goldman, Morgan Stanley, and all the governments around the world, all they've done is brought about this collapse. Marc's thoughts on what the final outcome will be from here would be appreciated.
Yes, I agree. They brought about the collapse. They were in charge, and they totally disregarded that excessive credit would lead to economic and monetary instability. And in his January 3rd speech this year, Mr. Ben Bernanke did not mention once excessive credit growth as a cause of the housing bubble and then the subsequent collapse, nor did Mr. Paul Krugman, who regularly writes beautiful articles in the New York Times calling for more stimulus and lower interest rates, ever mention excessive credit growth in a 7,000 words article last September entitled "How Did Economists Get It So Wrong?", which should have been entitled "How Did I, Paul Krugman, Get It So Wrong?" So you get the picture. Now these people, they have created the crisis. The response to it is to create more credit, but this time not on the book of the private sector, but on the book of the government. And the same people, the Geithners, Bernankes of this world, they will bankrupt the whole world. I guarantee you, because next train station is not that the financial sector goes bust. It's the governments that will go bust. Before they go bust, of course, they'll print money.
If you look at the period 2005 to 2007, Mark's absolutely right. We had excessive monetary growth. We had very low nominal and real interest rates. We had excessive credit growth. And that created, and Adair's Turner's comments earlier on about bubbles were actually very relevant, because what happened in that period 2005 to 2007, you had a consumer borrowing bubble, you had a housing bubble, and you had very loose lending standards in the banking system. Now, going forward, and I would totally agree with Mark's earlier comment, that we now have, obviously, a government debt bubble in a number of countries. And, you know, that inevitably means, I think, let's call it a devaluation of the value of government debt over the medium term. But that also means that if fiscal policy is going to be retrenched, albeit very slowly, inevitably that does mean in those over-borrowed countries we're going to have negative real interest rates. That has implications, very significant implications, for equity markets and currency markets.
In this environment, though, it just strikes me that at least equities and possibly some precious metals and some real assets will retain a value.
Yes.
And that's why you should lean towards them.
It's sadly the case. The worst investment in an environment where you print money and where in time, obviously, money will depreciate is cash and government bonds. I mean, that is poison, except for brief periods of time. Like maybe 6 months you want to hold cash, or like for 1 year in 2008. But by and large, the next 10 years, you don't want to be in government bonds nor in cash. You have to essentially shift rapidly between cash, occasionally when markets correct on the downside, and be more exposed to equities and precious metals, commodities, and even real estate at the right price.
Isn't the private sector going to have to bail out the public sector at some stage via some form of tighter tax regime? I mean, as much as the private sector is and has and will continue to repair its balance sheet, and the public sector is continuing to go the opposite direction, haven't the former got to pay for the latter at some stage?
Yes,
there is a relationship.
They'll pay for it through higher taxation.
So we can't actually say that we can buy equities and sell government bonds as a straight trade then?
The problem with higher taxation is that in the Western world, a lot of people don't pay any taxes at all because they don't have any money. And the well-to-do people, if you increase their taxes too much, they stop working basically, they stop investing, they go somewhere else because capital is movable. So they move out to Hong Kong, Singapore. That's why part of the increase in property prices in Singapore and Hong Kong is justified, because a lot of people, they want to avoid high tax regimes. Same for Switzerland.
It's not just capital that's movable, it's also
people.
Human capital is very mobile.
Yes.
But to come back to your point, I think it's actually one significant point at the moment is we are seeing in many countries the private sector balance sheet strengthening dramatically.
Absolutely.
For example, in the UK, 2 years ago, the savings ratio was negative. The savings ratio is now plus 8%. The US savings ratio is moving positively. So the consumer definitely is retrenching. Mark's right that inevitably, with these fiscal problems, you are going to see higher taxation. And for example, you know, at the risk of being UK-centric, yes, we will have an election probably in May, whichever government is formed after the election. And frankly, I don't think it matters. There will be fiscal tightening. VAT will go up to 20% or higher.
Richard challenges your thesis. He says Mark should change his newsletter to boom, boom and boom, because of late he seems to be saying the Fed can control the economy and can generate inflation and ensure stock prices don't fall. And you do have a positive view on the S&P for the next 3 months or so, whereas history shows us that what follows inflation is deflation and not more inflation.
Yes, I agree, but before we have the final collapse, that will be a deflationary collapse, we will have more and more money printing. And I'm not saying that the Fed's policies are desirable. I'm not saying that the fiscal policies are desirable. But you look at Mr. Obama and you look at Mr. Bernanke, they will have large fiscal deficits and money printing for as far as the eye can see. It will not help the real economy. That's the point. Money printing, go to Zimbabwe and have a look at the real economy. The output gap is like 95%. In other words, the economy is operating 95% below its capacity. But in an environment like this, what you get is stocks moving up and the value of paper money going down.
With very low nominal interest rates, low bond yields, negative real yields, very high levels of liquidity. And I think one indicator that one needs to watch very carefully indeed is the size of central bank balance sheets. And although there has been a big debate over the last 2 to 3 months about central bank exit strategies, the reality is that central bank balance sheets are still very elevated, so liquidity conditions remain very favorable. That means that the investment strategy has to focus on real assets, and particularly equities. And I think the only question is the equity market rally that we've had since mid-February, and which will continue, in my view, for at least 3 to 6 months, if not longer, how different is it from the equity market rally last year?